Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of our look at commodities ETFs DBC. We'll cover how to choose the right one, risks to watch out for, and tips to get started. You might think investing in commodities means buying barrels of oil or tons of grain. Thankfully, commodities ETFs make it far simpler. Imagine trying to store and trade physical quantities of these materials. It would be incredibly complicated and expensive for the average investor. Direct investment in commodity futures contracts also requires specialized knowledge and can involve significant risks. Commodities ETFs solve these problems by offering an easy and accessible entry point into the market. You buy and sell shares of an ETF just like you would any stock, right from your brokerage account. This provides several benefits. Ease of investment. No need to worry about storage, insurance, or the intricacies of futures markets. The ETF handles all of that for you. Liquidity. ETFs are traded throughout the day on major exchanges, allowing you to buy or sell shares quickly. This ease of trading is a huge advantage over less liquid direct commodity investments. Lower costs. ETFs generally have lower transaction costs compared to directly trading futures contracts. They also offer diversification within the fund, which would be expensive to replicate individually. This accessibility means even investors new to commodities can gain exposure without the usual hassles and high barriers to entry. Geopolitical events also stir things up. Political instability in a major oil-producing region, for example, can quickly impact energy prices worldwide. Environmental factors, like droughts affecting crop yields, directly influence agricultural commodity prices. These constant shifts mean that commodities ETFs can see significant price moves, either up or down, much more so than some other investments. Think of Contango as a cost you might pay. This happens when the price for a future contract is higher than the current price of the commodity. When an ETF rolls its contracts in a Contango market, it sells a cheaper, expiring contract and buys a more expensive, new one. This effectively creates a negative roll yield, which can erode your returns over time. It's like constantly buying at a slightly higher price. On the flip side, backwardation can actually help your returns. This occurs when future prices are lower than current prices. In this scenario, the ETF sells a more expensive expiring contract and buys a cheaper new one. This generates a positive roll yield, enhancing your overall returns. Knowing whether a market is in contango or backwardation helps you gauge potential profitability. Beyond tracking, management fees also eat into your returns. Every ETF charges an expense ratio, which is an annual fee expressed as a percentage of your investment. While these fees are generally lower than those for traditional mutual funds, they still impact your net gain. For instance, an ETF with a 0.50% expense ratio means you pay $5 for every $1,000 invested each year. It seems small, but over decades, these fees can significantly reduce your total wealth. Always research an ETF's expense ratio before investing to understand its true cost. Spotlight on DBC, an example of a diverse commodities ETF. For anyone looking to dive into commodities without picking individual assets, the Invesco DB Commodity Index Tracking Fund, DBC, often comes up. It is one of the largest and most well-known commodities ETFs. DBC bundles different raw materials into a single, easy-to-trade fund. This approach gives you broad exposure to the commodities market. It aims for a diversified mix, reducing the impact of price swings in any single commodity. Overview of DBC's holdings and investment strategy. DBC's main goal is to mirror the performance of the DBIQ Optimum Yield Diversified Commodity Index Excess Return. This index is designed to track changes in the prices of a variety of essential commodities. It covers sectors like energy, precious metals, industrial metals, and agriculture. You will find holdings in crude oil, natural gas, gold, silver, aluminum, zinc, corn, and wheat, among others. This wide range helps spread risk across different market segments. The fund mainly invests in futures contracts. This lets DBC gain exposure to commodity prices without having to store physical goods. A key part of its strategy involves managing these contracts to lessen the impact of contango. As we discussed earlier, contango happens when future prices are higher than current prices. When an ETF rolls its contracts, selling expiring ones and buying new ones, contango can reduce returns. DBC tries to pick futures contracts with later expiration dates that are less affected by contango. It does this by choosing contracts that offer the best roll yield when the fund needs to shift its positions. This smart approach helps to improve its tracking of the underlying index. Performance analysis and historical returns of DBC. DBC's past performance shows how it can act as a portfolio diversifier and inflation hedge. During periods of rising inflation, commodity prices often increase. This can make DBC's value climb, helping to protect your purchasing power. For example, when energy costs rise, DBC's holdings in oil and natural gas futures can see gains. In times of economic growth, industrial and energy commodities can perform strongly as demand for raw materials goes up. However, during economic slowdowns, some commodity prices might soften. Despite this, gold and silver, often considered safe haven assets, might see increased demand. This can provide some stability to the fund's overall value. DBC isn't immune to the volatility of commodity markets. Its value can go up and down. However, its diversified nature often smooths out some of these sharp movements compared to investing in just one commodity. Historically, DBC has shown a low correlation to stocks and bonds. This makes it a useful tool for adding diversity to an investment portfolio. Think of it as adding a different kind of engine to your investment car. It runs differently than your stock and bond engines. This can help your overall portfolio maintain speed even when one engine slows down. Commodities ETFs, like DBC, offer a clear path to diversify your investment portfolio. They provide a valuable hedge against inflation, helping to protect your purchasing power over time. These funds make it easy for you to gain exposure to essential raw materials without the complexities of direct ownership. Before investing, always do your homework. Think about your own financial goals and how much risk you are comfortable with. ETFs such as DBC give you an accessible way to enter the commodities market, but understanding their mechanics, including factors like contango, is key. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.